Do want to broaden it out, though. Take a look at the markets today as we are touching some new records this morning. Joining us, Anthony Saccaro, president of Providence Financial and Insurance Services. Anthony, great to have you back on the show. Another green day across our major indices. We've got two intraday records so far this morning. We may be pricing in peace in the Middle East. There's discussions of it, but we've done this before. How are you looking at the action we're seeing so far?
Well, hopefully we are going to actually have some peace. We've been talking about that for I don't know how many months. And I think the activity at this point is all based on what's happening over there. The Federal Reserve is in a situation where inflation, which is the topic at this point, is all caused by this energy spike, which is caused by the Middle East. And of course, they just held steady recently. Kevin Warsh is not giving us really a lot of forward guidance, so we don't really know what he's thinking. The market doesn't like that. That's why it dropped. But at this point in time, you've got inflation that's increasing. It's continued to increase up almost a full percentage point over the last 18 months or so. And you've got GDP that is slowing. We were at, I think it was 2.8% for 2024. GDP, we were at 2.1% for 2025 and 1.5% last quarter. That's continued to come down. So when you have growing inflation and slowing economy, the question, the word that's been thrown out is stagflation. Is that where we're going to go? I don't think so, but it's a possibility. It is a topic of conversation.
So if we're not in a stagflationary environment, if that's too strong a word for right now, how would you describe this backdrop that we have for investors then, Anthony? Because as you highlighted, we've got inflation that's moving higher again. We've got growth that's slowing, and we've got a labor market that's cooling. We just got a JOLTS report that came in a little bit lighter than expected. So if it's not stagflationary, how would we describe it then?
Well, I think the inflation is probably going to come back down. Most of the voters in the FOMC meeting recently, 9 of them basically said, we want to hold it as is. We think that the inflation or that the Fed rate right now is going to be fine. I agree with that. If in fact the war ends, if in fact we get that energy prices down, then I think we're going to be okay. And if inflation comes down and GDP stays moderate, which it very likely could do, probably in the high teens, maybe 2% or so, then we're not in that stagflation environment. We are starting to see the odds of a price increase or rate increase come towards the latter half of the year, though. But again, it's all dependent on that energy and when this war ends. It's energy that's driving inflation right now.
So as we look at inflation with the energy driving, I mean, headline CPI climbed 2.4%, and in February, but then we saw it pull back. Of course, when we saw the energy prices go down, now we've seen them move higher. So we're seeing it move higher. It's all tied to this energy conversation, which we're all feeling much more because when you go to the gas pump, we see such a quick rise in gas prices, but I think they call it the rocket and the feather. You feel it go up so quickly. It takes a very long time for those prices to come back down, and we haven't gotten permanent relief. So do you view the inflationary pickup that we're seeing again, this summer resurgence, as being temporary? Or do you view that perhaps this could prove more persistent?
Well, I think it's going to be more temporary, but it all ties back to the war. And when you look at the inflation numbers, when you look at the Fed comments, when you look at the economic environment in general, it's all tied to the war. That's the key. So as goes the war, as goes inflation, as goes the Strait of Hormuz, is what's going to determine how much you're going to be spending at the gas pump next week and next month. So it's really all tied to that. So when you tell me what's going to happen with the war, then we'll tell you exactly what's going to happen with inflation, because they are inexplicably tied together.
I wish I had the answer to that, and we would both potentially be billionaires or trillionaires. Unfortunately, I do not. So let's talk about payrolls then. We saw the growth slow. They added about 57,000 jobs prior months. We also saw some downward revisions. How are you looking at the labor market right now? Is that enough of a sign of a crack here? Is this a one-off?
The labor market is actually pretty normal at this point. It has absolutely slowed down over the last couple of years. A couple of years ago, there were twice as many jobs available as workers, so workers could go out and kind of write their own check and get another job. Now that number is closer to 1 for 1, so it's pretty normalized at this point. Average wages have come down just a little bit, but keeping pace with inflation. Because 70% of GDP in the US, though, is based on consumption, consumer behavior. You have to look at that as far as what's going to happen with the economy, with GDP specifically going forward. And the consumer is still strong. The consumer is still spending money. It's true that a lot of the spending is coming from corporations and this AI build out and industrials, but the consumers are still spending money as well, too. The interesting thing is that the savings factor for consumers, the average savings rate's going down a little bit, and the average credit card rate or credit rate's going up, debt is going up rather. So we do have to watch a consumer. And if the consumers have jobs, they will continue spending. If they don't have jobs, that's when you want to start paying more attention. And right now, we're in a low hire, low fire environment. The consumer's still working. You don't want to leave your job because you might not get another one, but you're probably pretty secure in your position based on where we are. And as long as you've got income coming in, you're going to keep spending. I would watch it, but I wouldn't say that there's anything in the labor market right now immediately to point us to the fact that we're going to have some major problems. But that's probably the number one indicator to watch going forward.
Then let's take a look at a sector that you like. We talked about the volatility in oil prices and the tie-in with the situation in Iran and that sort of being the wild card here. But you still like energy, despite this volatility. Specifically, you like the midstream companies. So take me through why you like them.
Well, I think, again, it's all tied to the war. How many times have we been talking about this war is going to be over? It has increased energy prices, and energy affects everybody, right? So when you're invested in this sector, you're going to take full advantage of that. But the reality, though, is you do have to be cautious. And that is because if the war ends and energy drops, you don't want to get caught with your pants down. So although I think it's a sector that you could pay attention to right now, obviously it's up dramatically over the recent months and year. The simple fact is that I wouldn't set it and forget it. I think it should be a tactical allocation somewhere in your portfolio, but not necessarily you want to put something you want to put there and then leave it forever.
And you also like industrials, constructive on industrials. What portion of industrials? Is it things tied to the build out, power generation, electrical equipment, et cetera?
Yeah, I think all of the above, right? It's the AI driven industrial that I like. You look at Arizona, you look at some of these other states where they're building these massive power plants. AI right now is just moving forward, and the expense is just massive. I'm a little worried about that AI bubble. But for the time being, these companies are building power plants, and it's that industrial component that I think makes industrials look attractive at this point.
Throwing out the B word in your last answer there, Anthony. We'll have to revisit that one next time we chat, but really appreciate you joining us today. Anthony Saccaro, president at Providence Financial and Insurance Services.